Hello everyone, welcome back. This is Microeconomics. So, in this lecture, we are going to talk about the price elasticity of demand and following the topics that we went over in the last lecture. And this time we are going to relate how price elasticity of demand to the total revenue of the firm. So let's talk about the total revenue. So what is total revenue? So total revenue, it's basically the amount of funding the seller receives from selling the goods or service in the market. It's generally calculated by multiplying the price per unit by the number of units sold in the market. So why price elasticity of demand relates to total revenue of the firms? Well, maybe we can actually think about this scenario here. Well, let's think about one day Best Buy is actually raising the price of all the flat screen TV in the market by 10%. So by taking that actions, will you expect the total revenue of Best Buy will go up, go down, or maybe stay the same? Well, of course, many people might actually say or claim that if Best Buy raising the price, well, people have to pay more and therefore the revenue will go up. However, this question it's mainly depend on the price elasticity of demand on flat screen TV. Let's go over the concept here. So the rule of thumb is when we have a elastic demand product, when price goes up, the total revenue of the firm will go down. Mainly because when people are very sensitive to any price change, a little increase in price will yield many people or many buyers in the market to cut on buying the products. And as a result, because the total quantity of the sold in the market actually drops more than how much the price has increased, and therefore, as a result, the total revenue of the firm will decrease. On the other hand, if the firm actually selling a elastic demand product in the market, and when the price drops, well, the revenues of the firm will increase. Again, the reason behind is when the price decrease just by a little bit, when people are very sensitive to any price change, well, the quantity that sell in the market will increase dramatically. And therefore, the increase in quantity of the goods actually greater than the decrease in price of the product. And as a result, the product of the two will actually increase in total. Well, on the other hand, if we have an inelastic demand product, when price goes up, the total revenue will go up. Again, maybe you can think about the logic behind. And when the price go down, the total revenue of the firms will also go down. So it really depends on whether the product has an elastic demand or inelastic demand. It will make a difference to the firm's revenue when they are setting their prices in the market. What about the unit elastic demand? Well, I guess you can try to think about the relationship between the percentage change in price and percentage change in quantity demanded. Here, when we're dealing with a straight line demand model, again, the straight line demand is a very common demand model that we've seen in this course, but it's not limited. So don't be constrained with the fact that, well, the demand curve can be shaped in different forms as long as it's followed the law of demand. But the straight line model, it's actually easy. So we're going to stick with that. When we're dealing with a straight line demand model, well, obviously, every single point on the demand curve will be different. The elasticity of demand on every single point on the demand curve will be different. You can give it a try to calculate the two extreme points when the price go from $60 to $70, which is on the top portions of the demand curve, or you can try to calculate the price elasticity of demand when the price go from $10 to $20, which is at the bottom of the demand curve sections. Well, either one way or the other, you will find the number of the two will be different. So as you move along the demand curve, the price elasticity of demand coefficients will be different numbers. They're not the slope, remember. So this is a very easy explanation on how we are going to define the elasticity of demand on a straight line demand curve. You will always be able to find the middle point of the demand curve in a graph, and this middle point, which demonstrates the unit elastic demand in the middle of the demand curve. At the lower portions from this unit elastic demand points, you will see the demand of the goods will be inelastic. When the demand curve is actually higher than this middle point on the upper portions of the demand curve, we know that the goods will be having a elastic demand. So why are we defining different portions of the demand curve with elasticity of demand? Well, because this helps our study a little bit on how firms actually setting the prices to maximize the revenues. Here's an example. Let's suppose we begin with some point here where this demand curve is pointing at $60 at the price of the goods. And this associated with the quantity of 2 units sold in the market. Well, on the graph below, we actually have a graph that demonstrates the total quantity sold in the markets and the total revenue that associated with that particular point when firms selling at the particular price in the market. So in general, if the firm is trying to maximize their revenues and they know that they are on this upper portions of the demand curve, well, how they would like to increase the revenue is by lowering the price. So by dropping the price, when the firm is facing an elastic demand, the firm will be able to see their revenue to go up. So that's a very easy way to think about how firms actually trying to set prices sometime in the market to maximize the revenue. On the other hand, if the price now dropped to $20 in the market and the firms are selling 6 units, well, if the firm want to increase the revenues, again, because this is in elastic portions of the demand curve, in order to raise the total revenue of the firm can choose to increase the price in the market so that the total revenue will go up. So when is the firm going to achieve the maximum revenues in this market? Well, obviously, the answer is looking at the top of this bottom curve. It's pointing at 4 units. And this 4 unit is associated with the demand curve at the price of $40. And that is exactly the middle point of the demand curve, where the demand is having a unit elastic demand. So as you can see, if we do have a hypothetical straight line demand model, it's actually very easy to see how firm can maximize its revenues by setting the price at that unit elastic point. However, I would like to warn everyone here, we are not talking about the profit of the firm, but we are mainly talking about the revenue of the firms. Well, there are other elasticity concepts that we would like to learn from this chapter. For instance, we would like to talk about the cross elasticity of demand, the income elasticity of demand, and the price elasticity of supplies. So we're going to spend some time to talk about them individually. First of all, let's briefly go over the concept of cross elasticity of demand. Or sometimes we call this cross price elasticity of demand. So the main idea for cross elasticity of demand is to calculate the responsiveness of how change in one price of the goods will affect the quantity demands of the other goods. So the easy way to think about is, well, this measure involves 2 products in the market, good X and good Y. And we are trying to investigate how the price change for good Y will affect the quantity demands for good X. Well, that might be a little bit confusing for some students at first, but we can actually try to use this example to go over the concept here. Again, we have the calculations for cross elasticity of demand. So it's the percentage change in quantity demand for good X divided by the percentage change in price for good Y. So give an example. We have the price of the MP3 digital music going from $10 to $12.50. So there is an increase in digital music. And at the same time, we actually observe the quantity demanded for music CD, which is a physical forms of music storage, go from 100 to 150. So because of this change in the market, we would like to ask the questions. Is there a relationship between the two products here, MP3 music and the CD music? And if it does, then how responsive the people are to the change of the prices for MP3 music and changing to buy more CD. Again, to do the calculations, we are going to calculate the percentage change in price for the MP3 music. In this case, it's an increase from $10 to $12.50, which is increased by 25%. And the percentage change in quantity demand for music is going from 100 to 150, which is positive 50%. So we have 50% divided by 25%. As a result, we have the coefficient equals to 2. Now the question is, how are we supposed to interpret this number? Again, the interpretations of this coefficient, it's not difficult. So for every 1% change in price for good Y, in this case, which is MP3 albums, there will be a 2% increase in quantity demands for music CD. So again, well, this coefficient always tells us about the marginal change of the price for good Y and the percentage change in quantity demands for good X. Well, one thing I would like to remind students here, if the price of the sandwich decrease, causing the quantity demands for the burger to decrease, this kind of illustrates what we learned in chapter 3 when we talk about supply and demand. So remember, there are two goods that can relate to each other. Either they are in the forms of related substitute goods or the supplements, the complements goods. So substitute goods basically are the one that you can replace with another one, and complement goods are basically the one that they are usually go together. So in this case, when people actually see the price of sandwich decrease and they buy less of burger, then obviously this tells us about the relationship of the two goods. So sandwich and burger, they must be substitute goods. So in the cross-price elasticity of demand calculations, you want to be careful because in the price elasticity of demand, we do not care about the sign of the number or coefficients. It can be either report negative or positive. And the reason is because we know the directions of the coefficients. It's always going to be negative. However, when we're doing the calculations for cross-price elasticity of demand, we have to be careful. Whenever the coefficient is greater than 0, it basically indicates the goods are substitutes. And whenever you see the coefficient is less than 0, then it indicates the goods are complements. Maybe you can try to think about what happened to the quantity demands of PS4 if the price of all PS4 games actually increased by 20% in the market. Do you think people still want to own a PS4? And how does it relate to our study here? Well, another elasticity concept also helps us to get the responsiveness measure. And this time we call this a income elasticity of demand. So the calculations for income elasticity of demand, it's basically using the percentage change in quantity demand divided by the percentage change in income. So the calculations or the coefficients here basically trying to measure the marginal change of income to the change of the quantity demands of the product. Let's take an example. Let's suppose there's a person incomes actually increase from $1,000 to $1,400 per month, which is a 40% increase. And as a result, the quantity demand for meatball sandwich from this person increases from 20 units to 24 units per month, which is a 20% increase. And what is the income elasticity of demand for meatball sandwich? Well, we're going to plug in the number. So we have 20%, which is the quantity demand percentage change, which is plus 20%. And we have 40%, which is the change of the income of that person. And as a result, we have 20 divided by 40, which is 1/2. So again, the interpretations of this coefficient is fairly simple. For every 1% increase in income, this person will buy 0.5% more of meatball sandwich every month. So again, the income elasticity of demand also, it's important to note the sign of the coefficients. So is income elasticity of demand always positive? And obviously in chapter 3 we learned that, right? So when income goes up, there are some goods that will have more people buying it, but when the general incomes level goes up, there are some products that people will actually not buying it. So it all depends on whether the goods is defined as normal goods or inferior goods. So in general, we can actually think about the two fundamental cases. When the income elasticity of demand is between 0 to 1 positive, we actually call those normal goods. When the income elasticity of demand is below 0, which is negative, and we call those goods inferior goods. And here we define one more. When the income elasticity of demand is greater than 1, we actually call those luxury goods. So those are the things that we are going to define by the elasticity of demand coefficients. And finally, we are jumping into the price elasticity of supplies. So again, if we calculate the price elasticity of demand by using the percentage change of quantity demand by the percentage change in price, well, in the supply side, we are basically flipping the quantity to quantity supplied. So give an example. If a sushi restaurant actually increased the supply of California rolls by 10% as the price of California roll raises by 5%, what is the price elasticity of supply for California rolls in this case? Well, we plug in the number, and here we see the 10% change in quantity supplied divided by the 5% change in price. And therefore we get a number or a coefficient here equals to 2. The interpretations of this coefficient is fairly simple now for us because we have seen this multiple times. For every 1% change in price, the quantity supplied will change by 2%. Or, to be more direct, because of the law of supply, we always know the coefficient to be positive. So, for every 1% increase in price, we know the quantity supplied of the goods will also increase by 2%. Well, in general, we talk about what determines the quantity, the elasticity of demand in the market. For elasticity of supply, it's actually a little bit easier. There are not many components to it, but the main factor that determines the price elasticity of supply is time. It really depends on what time periods we are involving in the productions. So when firms, they are trying to launch the products during the market periods because there is not much for them to adjust at that time. So the supply curve in the market will be fairly inelastic. And as you can see, well, in the graph, there is a supply curve that it's named as SMP. So the SMP curve basically demonstrates the market period supply curve, where the firm cannot make any adjustments of the quantity anymore. For example, you can think about like Starbucks. When you go to Starbucks one morning and you ask them, hey, you know what? I want to buy 100 croissants from this Starbucks today, right now. Well, every Starbucks actually has a supply from the distribution center. So they will have a fixed quantity of croissants in the store based on the historical data. If all of a sudden you are trying to buy 100 croissants from Starbucks this morning, they will not have enough croissant to sell you. And the maximum they can sell you, it's basically at that quantity they have received from the distribution center. And therefore, the total quantity will be fixed, regardless how much you are willing to pay to buy croissant from Starbucks. Well, on the other hand, when the firm is producing the product in the short-run production period, which we are going to cover that in the chapter 7. So short-run periods production basically means, well, there are some factor can be changed and there are some factor cannot be changed in the productions. And because of that, well, the firms can actually be able to be more flexible to adjust the outputs level, depends on the change of prices in the market. So even though majority of the production factor cannot be changed or adjusted, as long as there are some of the production factor can be increased or maybe can be changed, then they can actually at any time to produce a little bit more according to the change of prices. On the other hand, when the firm is producing in the long run production periods, and this is the periods where firms are not bound by any restrictions to change anything in the productions. So they can actually move to somewhere else, they can use different production plant size, they can apply different skill workers, they can make change on anything during the productions in the long runs. And therefore, this is the types of supply curve that you will see to be much more elastic than the short-run productions supply or the market period supply. So at the end, well, the elasticity of demand, the elasticity of supply, it's mainly determined by the time periods of the productions. So we have learned so much about all these different types of elasticity concepts. And also, we talk about how revenue is related to the elasticity of demand. In this chapter, we have one more section we would like to go over, and we will talk about next time, which is how the tax policy will be determined by the elasticity of demand or elasticity of supplies in the market. So whenever the government is trying to form a sales tax policy, well, there is always a study on how much revenue they can connect and how much welfare they can capture from the market, and as well as how much deadweight loss will be posted to the market. So we will study that all in the next lecture. Thank you for watching this video, and I hope you enjoy it. I will see you in the next lecture. Goodbye.